Hi, we are recording a quick example of the Bank Recon because I've got Ben here and he's asking good questions. All right, so we are looking at why do companies use banks? It gives them a double record. So the company keeps their own records and then the bank logs everything that's cleared the bank account. Okay, so you have a check and a balance. Probably the most important thing we walk through before we start the bank statement is the company and its relationship to its suppliers with respect to cash and its relationship to its customers with respect to cash. Okay. So money that the company pays to suppliers is cash going down. And so if you can see this color, it's pink. So cash going down, kind of red. Payments, money that the company is paid from customers is cash going up. I know that sounds simplistic, but it's easy to forget that. So the company makes payments with something called a check. And I know a lot of you do not ever write a check, but a check is a piece of paper that you give to somebody and they take it to the bank. And have you ever written a check, Ben?
I have, yes.
Yay! Have you ever cashed a check?
Oh, I'm not. Maybe?
What I mean is, have you ever received a check as a gift from somebody else?
I don't think so, no.
Okay. So in class yesterday, I asked my students that, and they said, we just take a picture of it and then we deposit it.
Hmm.
But in real company ways, they do it a little slower. So they mail a check to a supplier, and there may be a couple days before the supplier cashes it. The customer mails the check to the company, and it may be a couple days before the company actually walks to the bank and puts it in the bank. So let's look at this even bigger. Company pays cash to the supplier, customer pays cash to the company. So remember, when you have a supplier relationship, we use accounts payable. If it were employees, we'd use salaries payable. But the bottom line is it's money going out of cash. Customers are paying the company, and that's accounts receivable. And then when they pay, cash goes up and accounts receivable goes down. So over here, when a company pays accounts payable goes down. Sorry, and no, sorry. Accounts payable goes down and cash also goes down. So we debit accounts payable and credit cash. When a customer pays us, we debit cash, it goes up, and we credit accounts payable goes down. So cash increases. This is the cash T account. Cash increases from customers. And cash decreases when the company pays vendors, suppliers, employees. So let's say the company pays a bill for $29.50. Here's the check. And you can see cash goes down with a credit. And accounts payable also goes down with a debit. Here's a customer paying $20 to the company. This increases cash. You can see cash is debited here. And over in accounts receivable, it's reduced by 20. The customer doesn't owe us that money anymore. Okay. Now, for the bank recon, we first look at the T account cash and we say, what's the balance? So all your problems will start out with the company balance. Okay. And then the bank reconciliation has two sides. One side is the bank side, and one's the book side. And after we've done some calculations, they need to be equal. So all month long, the company writes checks. So when you hear the word check, if it's the company's check, it means cash going down. If the company receives a check from a customer, it's cash going up. So on the bank recon where you have check numbers, that's always going to be the company's checks. That's always going to be cash out, cash going down. Okay. Customers are paying also, and that's cash going up. All right. So the bank sends here's an ugly looking bank statement, and they're all slightly different. And your practice exam looks a little bit like this, but a little bit different. So the bank name is at the top, the company name is on there, and the statement date. It's usually end of the month, November 30. And here's the ending balance for the bank. Okay. The daily balance we don't really need, but we need deposits and checks. And Ben, on your practice exam, the checks are on the left side and the deposits are in the middle. So you want to make sure you read the titles really carefully. Okay. Where it says checks, these are the company's checks going out. They're paying suppliers, so cash out. Where it says deposits, the way deposits work is every day the company opens the mail. Maybe they have 20 checks from customers. They add them all up. And then, like, for example, on November 1st, maybe 20 checks added up to $420. We don't list the customer's checks on the bank statement individually. We list them as a total. The company will list it internally, but the bank doesn't list it. So on November 2nd, they had maybe 30 checks that added up to 630. That's increasing the company's bank balance. Okay. All these checks are going out. Okay. All right. And then we have these odd items. And since they're under the check column, that is also money going out. Okay. So what is this? RT means a returned item, also known as a not sufficient funds NSF check. It means a customer paid, it got put in the deposits, and then later the customer's bank says they didn't have enough money and they reverse the process. DM, we're going to have to read the detail, but it was a deduction. SC is service charge, $10. So all of those reduced the bank balance. Okay. Over here in deposits, we have the regular deposits, and then we have a special item, CM. And CM increases the bank balance. Okay. And so as we start the bank reconciliation, they give us the book balance. Okay. I'm just going to walk you through the completed bank reconciliation. Okay. So here, I always put the bank on the left side. It doesn't matter. You can put it on either side, and the books are on the right side. Okay. So I like to start with the book side, but you can start with either. So the book side, you just look at the bank statement and you pick up items that are not on the books. Okay. So typically you say under the deposit column, are any deposits there that I didn't record as a company? Then you add them. Under the check side, are there any other disbursements? Not our checks, but those CM, DMs, and different things. And of course, any errors. And then you calculate. Okay. So here you see under the book side, they looked at the bank statement and they saw that the bank had collected a note directly. It didn't go through the company. So they're going to add that. And then here they have things like a collection fee, a return check, and a service charge. And they subtract all of those and get the adjusted balance. Okay. On the bank side, we basically have two items, deposits in transit and outstanding checks. So let's do this next. Deposits in transit, you just compare. The problem either says this was a deposit in transit and you record it, or you look at the company records and the bank records and see if there's anything missing. So let's go back to that problem we were doing. Let's see. So we were looking at the practice exam and question 5, and they are telling us what the book balance is. So this is the books, and they're saying 873601, and no, we don't want that. And so I'm starting the bank reconciliation. I've got the company name, the statement, all of that, and this is my first line under books, balance per books. Okay. Now come over here and you can see I did a little T account and I'm showing that balance per books. So the book balance corresponds to the company's accounting records and under cash. Okay. So then over here, I'm just working through this problem. And I'm saying, how did I get this balance per bank? So we looked at the bank. So these are the company records on top, and we're going to use them to compare to the bank statement. Here's the bank statement for the same period ending October 31st. And you can see balance this statement 11,950,101. And then it's also here. So we're going to put that number 11,950,101. And we're just lifting that off the bank statement. Okay. So here's the bank records. So let's do the bank side. Here are all the receipts that the company recorded. And the question is, go to the bank statement, look at all the deposits the bank recorded. And if the bank is missing one, we want to put that under deposits in transit. Hasn't gotten to the bank yet. So can you find one there that's in the bank? Sorry, that's on the books, but not on the bank statement. And you already said it, but say it again, Ben, just for the video.
It was 967 on October 30th.
Perfect. So that's typical. Usually the last one is going to be, so the company booked it. It's in the 873601. It's in the T account. They've done the journal entry, but it's not listed here. But you can see the 843, the 941, and the 808 are matched up. Now, that first deposit, 548438, we're going to assume that that was already recorded on the books because it's already October 1st. Okay, so deposits in transit, here's your 967. So for the bank, we're now going to list any outstanding checks. So now we're looking at the company records under checks. This is money going out to pay suppliers or whoever. Check 17, 18, 19, 20, 21, 22, 23, 24, and 25. And we're literally going to tick them off and make sure they're all in the bank. And if anyone's missing, we're going to list it under outstanding checks. So 17, 372, there it is. Now 14, we're going to assume it's okay. It's cleared from a previous month. 18, 780, 62. 18 did clear, but it's a different amount. So you'll notice below that's addressed below. So let's hold off on 18. 19, 157 per the books. That cleared 157 per the bank. So what's missing here, Ben? Which checks are missing?
I'm seeing 587.
Look at the book. So number 20, yeah, number 20, that's good. Number
Also,
20, and I'm going to say 587.50. What
and
else?
also
21 is good.
23.
Good. And that is how much? 1/6. Good. And 24 is good. And 25 is good. All right. Let's, all right. That sounds good. All right. So that's it for the bank. So now let's do adjusted balance per bank. Okay. And we're just going to add these up. And we don't know if this is right yet. We're just adding this up and hoping for the best, okay? So now we got to do the book side and we are hoping we get the same number, okay? Are you with me? Is that good? Does that make sense? So the bank side's
Yeah,
pretty
that.
easy. It's just
Uh-huh.
deposits in transit. You look at the company records and you say, what's in transit? And then you look at the company checks and say, did all of these, are we missing any of these in the bank?
Yeah,
So
that
they,
one that makes sense.
yeah, so that should be pretty straightforward. So now for the book side, we look at the bank. So we start with any deposits. We look at the bank records and we say, well, is anything in the bank that is not recorded by the company? Okay. So start with the receipts. So we go down here and we say, is there anything down here that isn't recorded by the bank?
Uh, I'm
Did I
seeing
say that
the
backwards? Is there anything in the bank that is not recorded by the books?
uh, I'm seeing the 5,484.
Yeah, and you can see it's not up here. And because it's deposited by the bank on October 1st, we are going to assume it was from the previous month.
Oh, okay.
And I need to add that to the instructions, but yeah. So what else is in this list that it's in the bank, but it's not up above under deposit, under receipts?
There's also the 2,100.
Good. Okay, so let's put that in. And they've broken it down here in the comments. They're saying, see how this says CM, that stands for credit memo. The credit memo is for a collection. That means cash goes up. That's why it's under deposits of a note receivable for 2040 plus interest. So I'm gonna say note receivable here, 2040, and then I'm gonna say interest. And because it's a collection, that means it's interest revenue. Okay. If it were a payment, if it were money going out, it would be interest expense. So the book side's fairly straightforward. You're just lifting whatever's in the bank that you don't have already in the books. Now we've got less. So now we've added these in. Now we're going to look at the bank statement under checks and see if there's anything down here that's not up here. We're going to deal with this check number 18 in a minute, but let's start with just looking at things that are here that are not recorded by the books. What do you see?
I'm seeing 1,448.29 cents.
Right. And since it's at the beginning of the month, we're going to assume it was already
Clear.
recorded by the books.
Okay.
Okay. Okay. So what else?
Um, there's the NSF one.
Good. And because it's negative, because it's under check, I'm gonna add this here as minus 230. Hey, how are you? We're just doing some review and then how about I say it right? In as F, okay? Anything else?
And then the service charge.
Good. And it's 35. That's a big service charge. Okay. All right, you are almost home, okay?
Okay.
So now so this is how I do it. I do the straightforward stuff first, okay?
Mhm.
Because it's doesn't really change. I just lift, so all of these come off the bank statement. They're just there for us to take. You can just read them off the bank statement. The only detail here was that you had to read the comments to know how much was the collection and how much was interest revenue, okay?
Okay.
But now we've got an error. Okay, we've got an error that that we can see, right? And it's check number 18. So now it's time to look at this additional detail. So check number 18 was correctly written for 708.62 for a payment. So 708.62 was cash going out. Okay. But you can see up here, the company erroneously recorded it as 780.62. So the bank is right, the company is wrong. So I want you guys to think about this. The company deducted cash of 780. They should have only deducted cash for 708. So what's the correction? What do we have to do to make this good?
Uh, uh,
So let's put it over here. So in this number here, they did, and I'm going to leave off the pennies because the pennies didn't change. They did minus 780. They should have done 708. They should have done minus 708.
do you have to add back the $72 then?
Yeah, you have to add it. Good. You have to add it back. So we're going to put it up under the pluses. We're going
Oh,
to say error number 18 and add the 72 there. Okay. Now, if you get through the whole bank statement and there's an error and you don't understand how to fix it, you're either going to add it or subtract it to the books. The bank
okay.
doesn't usually have errors anymore. In the old days, they did. But you know that to fix it, you either add it or subtract it, the difference. Okay, so here we are. And the question is, do we have adjusted balance per books? Okay, so we're going to add all of this up and hope and pray we get the same number, and we do. Now, what happens if you don't? Don't panic. I give partial credit, but this is do what you know, do as much as you can, and I will give you partial credit. No, and this is what happens to students. They put things on the wrong side. Know that the bank has deposits in transit. Know that the bank has outstanding checks. Okay. That's not part of the books. It's part of the bank. And then the books side, you just look at the bank statement and say, is there something there that's not recorded yet? And then we have to record it. Okay.
Okay.
Now, you are not done yet because we have to take these 5 things and make journal entries out of them. Okay. And they're pretty straightforward. They're going to be easy because these 3 additions, the journal entry is going to be debit cash for each of those. For these 2, the journal entry is going to be credit cash. Okay, so let's just build them. So journal entry number 1 is debit cash, 2040. And we don't know yet what the, I'm going to just put that here. We don't know yet what the other account is. Okay, so that's journal entry number 1. We're not done with it yet. Journal entry number 2, I'm just going to copy this down. Journal entry number 2, we're debiting cash for $60. Journal entry number 3, we're debiting cash for 72. Okay. Now your job is to tell me what account gets credited. So you have to read what this was. This was a collection of note receivable. So we had a note receivable, but now it's been paid. So we're going to credit note receivable. And let's indent that. Okay. This is interest revenue. Interest revenue goes up with a credit. Okay. This is an error. We're going to come back to the error. Okay. Now these 3 are going to be cash is credited. So let's copy this. You know what? I'm going to make these green to show you that cash is going up. So all of these, and we're not done yet. So these are going to be pink to show cash is going out. All right. Okay. So now we have cash is going out for 230. And then we have another one. cash is going out for 35. Okay. All right. Does that make sense?
Yeah.
So we have to book all of these and then we'll post them here and our ending balance in our T account. So that this is the only way those transactions get into the company's records. We have to do that. Okay, so we've done the three. We collected the note, reduced the note, increased cash. We got $60 in interest revenue. We credit interest revenue and we debit cash. And then this error, we're going to talk about that in a minute. And then here, the NSF check and the service charge. So let's do the service charge first. This is a new account for you guys. It is service charge expense. Okay. Okay. The 230 is a check that was cashed. So we originally increased cash. And the problem says an entry has not been made for NSF check. So we're going to assume that was a customer check, which means accounts receivable. So this is going to be accounts receivable. Okay. Okay. Now, what do we do with this guy? So you guys good with these three? So remember, all those adjusting entries are either increase cash or decrease cash. Increase with a debit, decrease with a credit, and then you have to figure out what account to use. Now,
Okay.
now for this last one, this was a $72 error. This was a check that the company wrote. So when a company writes a check, that means accounts payable.
Mm.
It could be salaries payable, but they have to tell you that. Okay. So if it's accounts payable, we need to correct accounts payable. Okay. Okay. And then you've got it. All right. A little bit of a long answer, but I wanted to walk through that with you. So you have your bank recon. Let's say you don't balance. You still know that you have to make correcting journal entries for anything you have under the books. So if I were to post these journal entries to cash, I'm not going to do the full posting. And then I would be to run a new total equals sum. Hopefully it'll do it for me. Yeah. So once I book those journal entries, now I'm not only proving my balance on my statement, I've actually, my records, my accounting records are now accurate. Because I have to post anything on the bank statement that is not in my books. So it bypasses the company. So, all right. Okie doke. All
No,
right. Go ahead.
no, I just say okay.
Oh, okay. All right. I'm gonna stop this video. All right. Stop record.